Welcome to Wall Street Confidential on TheStreet.com TV. Jim, we have a little bit of a love-hate story today with Apple and MasterCard that we want to talk about.
I do not like tech. I think that tech, by the way, when we think about tech, we should be thinking about Parker Hannifin, Eaton, Trinity. But tech is National Semi and Analog Devices and Intel and Microsoft, all these companies that basically are just trying to make a PC go a little faster, except for Apple. And Apple is a game-changing company. And yesterday, when the Fed didn't do what some wanted, Apple was down $1.50, and I was pounding the table. I'm going to pound the table until Apple releases the new generation of the iPhone that I believe will have an iChat function. The way Apple works, it's very important for everybody to realize, the way Apple works is it goes up until the release. The run-up will not stop here, especially because it's bolstered by the fact that Macintosh sales are very strong because of iChat. Now, MasterCard's very similar. There are no financials that are buying back stock that aren't diluting themselves, except for Goldman, which I like but has made a big 40-point move. MasterCard fits that bill. MasterCard is raising margins. It's buying back stock. It has got great momentum, and it's still inexpensive. Most importantly, the reason why I'm focusing on these two stocks is what people don't understand about the money management business is there are funds that are dedicated to tech, and there are funds that are dedicated to finance. Okay, that's their charter. Or they're funds that are trying to be weighted to the S&P, and finance is 11%, down from 20%, and tech is, say, 10%. So they have to own, just for the weighting purposes, they have to own some tech, and they have to own some finance. MasterCard, because it doesn't have any debt problems, it has no debt, it is just a service provider that's regarded as a financial, is where they're going there. Apple, because it has genuine growth and actual catalyst going forward, is another place they're going. And that's the way they're thinking. That's why every time these stocks drop, like they did yesterday after the Fed meeting, you gotta go in and buy them. There's not a lot of stock, Apple and MasterCard, for sale. I have emphasized these over and over because I'd much rather say be an Apple than switch right now to Intel, which has no momentum. I'd much rather be a MasterCard than say go buy the Citigroup equity offering. These are great stories, and I'd rather focus on the great stories and forget other things than I would say, wait a second, here's something that might be as good as Apple, because I don't have it.
Did the time of opportunity pass?
What I'm doing on this video is saying that every day there is a moment where the market looks bad. We have had this happen over and over and over again. Right now it looks bad for natural gas, which is a group I like. When it happens, you got to be ready. Apple was up 3 at one point yesterday, and then it was down 2. That's the entry. You're not going to get down 10 Apple between now and when the new iPhone iteration comes out. You're just not.
Okay, thanks, Jim. You got to watch for that moment. Stay tuned for more Wall Street Confidential on TheStreet.com TV.